Hello, everyone. Fantastic. It is FOMC yet again, 26th of July, 2023. So this is the, what do you call it? Um, the radio check 1 2 3. How are you guys? Are you doing absolutely fine? This, I would say, this evening, because this evening for me, sun is about to go a bit lower at least. And today we're gonna expect. I want to expect that Mr. Powell wants he is going to literally going to say, what, I believe in this. I believe in this falling in CPI. I acknowledge it, and we are going to go dollar bearish. I have already made my plan earlier, and it doesn't seem like it's going to be great. But you know what? It doesn't really matter because I believe. So I hope you guys have brought out your trading counts, that you have everything ready, set, and go. Ian, good day, mate. Princely, Xavier, Roxana, as always, all good. Boz, boom, as always, and Marilyn, welcome very much. So I'm gonna give you my two little tips, or my two little things for today. Number one is that I I want to see that he comes out and says we have lower CPI. That is just wishful thinking, because if you look at the market, if you look at FX Street has come up with an article that says, Fed has been struggling convincing the market that they will raise the rate at least twice this year. And if you look at the CME, they are almost something small there for a double rate hike today, but it's very small. And by the end of the year, we are seeing a bit more and more that this 55 to 575 type of theory is getting creeping higher and higher, and that is the double rate hike. But the market has not been convinced so far, so maybe today they are going to be convinced even further. All right, so the market is expecting them to raise their rates by 25 basis points to 525 and 5.5 range. Now that is, or the Fed funds rate. Now that is well expected. We all knew that, and that might be the peak of interest rate hikes that we have seen. I don't know if they are most unprecedented that's ever happened in this entire world, but it's been a rapid raise to current 5% interest rate. It hurts. It hurts to have interest rate at 5 to 5.25. It is not easy for anyone, let alone Fed. So I hope they acknowledge that. Um, and I hope that what Forex Live is posting out today, that they will be tempted to take a picture up. I really gone down that path of that they are going to see that headline CPI has been down and is below 3% and is on the 2 mark, 297 by the way. So yes, it is still 8% away from 3%, but you know what, if they just pause and see one more CPI for August and September until their next meeting, I think that they are going to be September. It's going to be an easy pause and peak. Now we have to have in mind that Canada also did a pause and peak. And what happened to the Bank of Canada? I might ask people, what happened to Bank of Canada? Because somebody tell me what happened to Bank of Canada. They did what? They were hiked again. So nothing really fantastic in that direction. Now, let's see if I can. Okay, that was the wrong screen. Cool. Okay, cool. Okay, cool. So we see. Let's start the slideshow of. That was not really. Like, I don't know how am I supposed to do this fantastically. Thank you very much. So, what is FOMC? FOMC is determining the direction of monetary policy. They are a committee that decides the monetary policy. What is their job? Is to influence the availability and the cost of money and credit to help promote or discourage national economic to promote national goals, but also discourage economic growth because it's too high, as we have been seeing lately. How does a change in the federal funds rate affect the market? Short-term effect is interest rate affects long-term interest rates, the amount of money and credit, and ultimately a range of economic variables, including employment, output, price of goods and services. What is the key indicators of Fed? Inflation, unemployment rate, GDP, housing, households spending, consumer sentiment, and business sentiment, and manufacturing PMI, service PMI, composite PMI, bond market, stock market, forex market, commodities market, global market, fixed investments, and other risks to economic development. How does the Fed implement their monetary policy? By lowering and rising the Fed's funds rate, bond purchases, and deposits. What is the goal of Fed? 2% inflation, 2.5% ish on the GDP, and unemployment at 3.5. I might need to change that to 3.9 because 3.5 is a bit too hard. It's a bit too squeezed as we currently are at unemployment rate, and let's say that it's a strained market. All right, cool, good. Enjoyed a little bit of FOMC slides there. Can't complain about that. Hello, Lee. How are you doing? And we are lacking one member today. We are lacking Jack today. He is in the military, so say I salute you and hope that you have a wonderful time while being in the military. But other than that, enjoy time, and we wish that you are coming back soon, no down later. And when you come back, we will absolutely be thrilled to have you there. And I know there's other members. It's on summer holiday this year, so I know that you will see this recording and we miss you. Other than that, 23 people here right now. That is great. I love that. Trade plans. What is your trade plans, community? What is your direction? I want to hear your input. I also want to hear that the reasoning. What are you looking for in the hello PK? What are you looking for in the statement for you to jump on that direction of trade? Other bullish or bearish? What is your deal? Hello, Naveed. So my point with that question is, I need you to think. I need you to know, understand what are we looking for. First of all, I'm looking for inflation to be acknowledged going lower. I also want the rate of what do you call it in English? The rate of wages to be acknowledged to be high. I also want you to I want them to acknowledge the current employment market, which is very tight. I also want them to acknowledge the falling indicators, the PMIs, as far as I remember them. So for now, and also the fall in interest I've got my mind. I need to go back to bed. House prices. What do you call that? Real estate prices. So in that direction. You are bearish on USD, waiting for a new lower low. Seasonality is bearish for the pair. Okay, good. I love that personally, that you're giving out your opinion. And I can agree with you. The only problem, so I saw earlier today, I think it was FX Street comment. It was about what all the headwinds for the Australian, and if I can just quickly find it for you, here it is. Aussie dollar has a very limited upside. Historically, longer term rates have been more of a driver, and the suggested pair is going nowhere. Either way, we see no catalyst for a significant Australian dollar rally. And they see that weak regional growth trends amid slower than expected Chinese GDP, plus the still soft terms of trade represent headwinds. Sentiment and positioning remains negative, and RBA have little more tightening to do, but the policy cycle looks nearly complete with inflation showing signs of peaking as well as everybody else does. So they were talking about the 68, which is the current high of, it's a high of this morning, I think it was, on Australian. So yeah, okay. So they say it going down to was it 67 or 65? Sorry. So they see that Australian dollar can go all the way down to here, and that's what they currently are expecting. So you still have a good room to fall if that's where Australian dollar is going to go. My lovely Roxana, she says, I'm waiting for gold to go bullish. 5 minutes left, by the way. Can somebody do a countdown? Hello, Teddy. Long time, I see you always, kind of a thing. Can I teach you for free, Naveed? If I have time for that. There is a reason why there is a price on it, because I don't have time. But yeah. So when you ask me for free stuff, everyone falls off when I start giving you the requirements. Okay? So what I want you to do when you ask me for free stuff, become expert in support and resistance, trend trading, trend reversals. Send me a bunch of charts that proves to me that you are expert in those areas. Start learning about central bank policy, monetary policy, central banks, and learn about money flow, risk off, risk on, what makes the price moves, and in the moment and the day you can answer me what moves the currency prices. Then we have come a far way. The only way that I did it for free was by studying. And when you ask someone to say, when you say, do this for free for me, I already gave it to you. Now it's your job to do it, because everybody has to do that. So, other than that, people, we have the Fed. What do you call it? The Fed Open. We should probably also have our good friends at Financial Juice Open as our squawk. So I'm going to have that on one screen, and then I'm going to have some others on some other screens, and then we'll still see if I can get some niceness in. I just added some music to you guys. Tell me if it's too high, but that is all. That's all good. Oh, you have changed your email. Like, you have changed your Google, like your YouTube accounts now. All right, great. So Naveed, if you want to talk to Princely, great. He's also a student of mine, so that's also great. So I love my community are working together to get things done. That's all right. I have no problems with that, as long as that relies what do you call it in English? That relies responsibility on you, Princely, to do the right thing. Anywho. So are we prepared for the statement today? Shall we see if we can find the previous one, just to see what we're looking for or comparing it to? So the past one is recent indicators suggest that economic activity has continued to expand at a modest pace. Job gains has been robust in recent months, and employment rate has remained low. Inflation remains elevated. And I want that sentence to change. Hello, Garvan. How are you? And which currencies are we going to look at today, people? Can somebody tell me which currency we're going to look at? I'm going to look at euro. If you guys have any other inputs, make your statements quickly. All right, I have 50 seconds. 40 seconds left on the clock. I have 30 seconds left on the clock. All right, I'm ready. Okay. Trading forex is risky, not for everyone. If you're putting money on the account today, it is 100% your choice. I do not make anyone. I have not met anyone. I don't want you to trade if you don't know what you're doing. If you've been doing this before, great. I wish you very luck. Get set. Get ready. 3, 2, 1. Let's go. Refreshing. I am refreshing as everybody else. There it is out. Let's see. Let's leave. Let's go, baby. Recent indicators suggest economic activity has been expanding at a moderate pace. Job gains has been robust in recent months. Nay! I didn't get what I wanted. No! The U.S. banking system is sound and resilient. The extent of these effects remains elevated. Uncertain, sorry. They did raise their interest rate to 5.25%, as expected. Okay, all right, okay. It is sound and resilient, and they will continue to test additional information. Blah 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 blah. 2% target. Blah blah blah. In assessing the appropriate policy, committee will continue to monitor the implications of incoming information and the economic outlook. The committee will prepare to adjust the stance of monetary policy appreciated if risks emerge that could impede of the goals. Okay, so I now need some help because I can't read while I'm stressed and with you guys. What am I expecting for JPY pairs? Nothing much, to be honest with you. I want them to have a rebound, to be honest. And they have continued to reduce their bond holdings as I don't see that where that is, but maybe I'm blind. Maybe there's more. Oh, here it is. Okay, sorry. You're just gonna have some silenceness from me, but cap of 60 billion per month, and they're continuing to reduce their bond holdings. Reinvest mortgage-backed securities at 35 billion per month. Allow modest deviations from stated amounts to reinvestment if needed for operational reasons. Okay. Joe, do you have anything better than that I have been able to put forward so far? Okay. So go back to euro, go back to pound, go back to gold. Gold has been in a range today, also given the rest. How the rest of the day performs is based upon Powell now. So as far as I am concerned, we can go back to looking at trading steps, by the way, because I want to trade this thing, but nothing new. So this did not Did this not make me do any trades, by the way? Yeah, it is kind of the only thing that I don't see anything new. So you can also see that in the reaction of the market on gold, for example. We are close to the opening price of this hourly candle. So nothing new was told. Euro is pulling back, as you would expect. And so the yen pairs, if dollar gets stronger, yen tends to weaken, or vice versa. If dollar weakens, the yen then tends to. If dollar weakens, the yen tends to strengthen. The S&P 500 has come a bit down this morning, but I would say still has plenty of room to go higher. I'm just going to see if I can find the wordings around future policy. Yeah, so I guess we need to read into what Powell says, specifically what it says about acknowledging the lag, which monetary policy is affecting the economy. Yeah, okay. Continue reducing holdings of treasury securities. Okay. So it's kind of like, yeah, I don't see that. So we need to hear what he says about future rates, and I think that's where the money shot is going to be this long. And it's always going to be like that. It's always going to be like that. We'll probably end the day with a weaker dollar. If everything stays the same, if Powell doesn't change much. Now, the whole problem and the whole fun about this is it comes down to wordings. Which words and how is he perceived when he expresses those words? That's going to be the difference between everything. Can somebody hear music in the background, by the way? Not anymore. Yeah, I understood you. All right, we can go over to markets. S&P 500 is still bullish. By all means. And continues to rise. I don't see any reasons to short. I don't see any reasons to panic. I don't see anything here at all. I bet that Frank and Nick should continue to look for, and as well you should look for continuation higher. Fed to consider extent of additional firming to curb inflation. U.S. interest rate futures put a chance of rate hikes at 18% in September, 36% in November after the statement. So the market has now priced in slightly less expectation for a rate hike. So 1% down. 1% down. So Mr. Sheikh asks for Nasdaq and natural gas. So what is happening is that when we on 1 hour came down lower there and we crossed lower, we are short-term bearish. It is about to happen again. So you literally right now need to see a higher high, higher low for it to be short-term bullish. So any day, any moment, higher highs. If you're shorting it, that's a whole other situation that I'm not really prepared to talk about because With peaking inflation, with peaking interest rates, this one should have a dream day and a dream moment and a dream year, which it currently have been ever since March. As you can see, it has risen 33%, which is absolutely phenomenal. So it's just to continue to look for buys. It just continues to look for continuation. I don't see any reasons of why Fed will do anything differently. So to me, anything. Also, I would even argue that this is a great buy area. But if you can get it a bit lower to 15,000, still very much in line with that. And then natural gas. By the way, if you want me to go through your trading setup, your asset, add them in chat, and I will do that. Excuse me, where is that? There should be like actually I haven't. Okay. Create a banner. Okay. So natural gas. Natural gas has been a very interesting thing though, because it has just gone into a range. So I would say that the gas market is kind of dead at the moment. I should not be trade. You should not be. I don't know, you can trade it for that matter, but the volatility that has died out, and 2.6 is like a pre-COVID thing. So it's at a place where pre-COVID, yeah. I'm just gonna find pre-COVID. Yeah, 2.5, 2, yeah. So it's back to its normal self now. I don't think it's gonna stay there because the natural gas market has been solved. There is not a scarcity there anymore. But natural gas kind of dead, and Nasdaq should just be continuing higher. To be honest with you. Japan. And I can. Why do I read Japan when I type Japan? 5, which is a Japanese 225 index. Well, also, to be honest with you, it's a straightforward higher high. Komika. And it has a pause for the past summer. So as long as the ultra loose monetary policy is still in place in Japan, it's still a move higher. Hello very much, Halda. Welcome to the stream. So I really want to think like, what is monetary policy in Japan, and where is it going, where is it heading? And they're going to have a meeting on Friday, and I'm not going to stream that, but they're going to be like, okay, we are not going to tweak the yield curve control. Then this thing eventually is going to go higher. So to me, it's more of to me, it's like more the waiting game of waiting for it to go higher. Just reading news for you guys. Fed, yeah, consider to extend an additional firming. All right, okay. I guess it is what it is then. Stocks is in negative territory after FOMC statement. Couldn't care less, by the way, people. Yeah. It is what it is, I guess. If you're thinking about a trade going forward, I'm still very much waiting for this euro to go higher. Is your JPY current price a good buy for setups? Also, yeah, I feel like it's like 70% done falling because this looks a much better place to be buying from, and this looks like it's like a hangman. It hasn't really completed what it wants to do. It doesn't really know what to do, and it doesn't really seem to know what to do. And yeah, of course, if it goes higher, fantastic. But other than that, I don't think it's a place for us to be thinking about buying. That's not a technical level that I'm like, ooh, lovely, fantastic. So I guess it is what it is. What about seasonality on it? I haven't really checked. Well, it's supposed to fall, as far as I know. So I'm supposed to expect that from 1st of August. It's a bit early, or yeah, 20th of July until 10th of August. And if you look at some of the years on euro yen, because I probably should have sold it there and just twisted my position around and all that. But I'm just thinking about the current monetary policy, which is ultra loose. So if you look at it here, you have 13th of July, and then 20th of July is the bottom, goes back up to 29th and 1st of July, and then it falls. And then you can see over here, which is 21st of July, 20th of July, and then it falls last year down to 1st of August. And if that happens, I'm just gonna buy it instead, just for the fun of it. But to be honest with you, it's kind of like, I don't know if it didn't run away from me, but I have a plan about first. And if first doesn't happen, I'm kind of not gonna care, because I am carefree about euro yen. Elda says that I wish euro dollar would go higher. Well, the thing is, Elda, you're in good company. I am expecting it. Expecting is the word. I am looking forward to happen today. And if it doesn't, sure. I hope you don't. I don't have any. I don't hope you don't have a lot of money on the line on your buy to the higher side on euro. So you can, if you can find out what Powell is planning to say, then that might help you out. But it is ready to go both ways, to be honest, technically. CAD yen and Aussie yen was like bullish lately, and I'm like, okay, cool. I don't know if I like it, and sure enough, the bugger comes lower, and I'm just glad I didn't buy it. I was thinking on Monday, why not? And sure enough, it did come lower. So it is what it is, I guess. So if you're thinking about anything like fund seasonality wise, you're supposed to short it, and it's currently turning bearish. So fun games. But fundamentally, right now, it's a bit of a struggle game. It's a bit opposite. But of course, if you get comments from FOMC, no, sorry, Bank of Japan on Friday that they are going to start tweaking or they're going to increase their inflation target, this one's going to drop like a stone. So that's definitely going to be helping bears. So then again, you have to anticipate, what is the Fed going to say again? No, what is the Bank of Japan going to say on Friday on their interest rate meeting? And do you think they're going to say they're going to increase their inflation target, or if they're going to tweak the yield curve control or do any changes to monetary policy, then you have a right there. But at least you have been warned now before that all happens. Can't that candle just be like end the day here? Oh, that would be so great. So what am I waiting for? I'm waiting for euro dollar to do that and then that. If that happens in one candle, then sure be it. That's what I'm waiting for. I got it yesterday trying to pass my 15 challenge. 5% is what I need. All right. I would probably have tried to buy New Zealand dollar if dollar goes bearish. There you go. New Zealand is going higher. I'm waiting for it to go higher. So okay. Either buy this one or not. I'm telling you to buy. But if so, New Zealand dollar higher. If not, if New Zealand falls, then Euro New Zealand higher. We haven't looked at pound even. Okay. So what's your direction? Well, for those who are trading pound dollar, I know there's people in here that trades pound dollar. What is your direction here? What is your opinion about the CPI, the inflation out of UK? I'm just going to troll Nick for a moment. Somebody says buy gold. Maybe we should go buy gold and see what happens. Okay, so as far as I remember, for UK inflation, it's coming down. It's probably the higher one of all the G10 countries is 7.9. So this is how it looks like. It was at 11, but now it's 7.9. But still, it's still very high. So they are still going to increase interest rates going forward. It's just that it's not going to be as straightforward on pound as everybody else wants it to be. Like I would like that strength, that high inflation to really make pound strong, which it has been doing. And this is technically reversed, to be honest, in my views. So this one's probably gonna go before I get an entry on it, but I'll definitely just wait for Powell to come out and speak on it. Bullish on pound above 129.60. Was 129.60 there. So you want to pass that high there? Okay. Yeah, I can agree with you to an extent, at least. A small extent. Somebody in chat to the next chat says that the Fed paused interest rate level meeting. Did they? I don't think they did. Like, am I blind? I'm laughing for myself because that didn't happen, did it? I thought we have been raising every meeting. How am I tricking? Yeah. Oh. Well, that did. Okay, then he's actually right. I thought they actually increased last time. I thought it'd be increasing every meeting. Okay. Sorry, my bad. My bad. All right, 6 minutes left until we have another 6 minutes until we have the start of the press conference. In the meantime, actually, not in the meantime, let's go through the market. I am gonna say what I really want us to do. So why can't you just thank you? So I'm looking for another entry on S&P 500. To be honest, if that is 45.20, if that is 44.60, so be it. I'm looking for euro dollar to go higher. I don't know if that's gonna happen. Pound dollar can go higher and can be like, okay, fine. New Zealand dollar, US dollar should make a higher high before buying anything else. If that doesn't happen, then euro New Zealand is going to be my other trade. If New Zealand starts to fall, then euro New Zealand is going to be my scapegoat. So I don't trade dollar, I just trade New Zealand falling. That is due to strengthening of dollar. So it's kind of like in between there. It's not moving much. Yeah, so far now, but once Powell starts speaking and he starts giving it directions, he's going to move at least 50% in his direction. And if there is no direction at all, then so be it. But if he gives us a dollar bullish direction, I think that we on dollar today should be knocking on 101.60 to 102, sorry. So somewhere in this direction, I think the market should go if he gives us a dollar bullish. We are very scared of interest rates, still very elevated. Also, we're very scared of inflation, very elevated. I think this is the area then. When it comes to Aussie yen, it's a range or bearish. CAD yen, it's bearish, which is pretty funny, which is kind of what you would expect in this time period, personality wise. Pound yen is kind of in nowhere land, and New Zealand yen kind of in nowhere land as well. But if it breaks the support, it turns bearish, and you can sell it off, and off you go. Then US yen, on the other hand, is actually fulfilling what I did plan out on Monday, though it just takes a bit later time and is a bit higher than expected, but still. It did go a bit lower with dollar weakness and yen strength. Oil continued to rise this week, didn't come back down to where I wanted to come back down to, so that was no entry there. Gold has today been going in a range like yesterday, and then a new range today, and then we shall see if we are going to break higher or lower with Fed. If he gives us, he's concerned about inflation still being elevated, this gold thing is going to go down. Short term, at least. And USD Swiss should be then going higher. 2 more minutes. Is it 2 more minutes? 1 more minute until Powell comes out. Let me go over to Federal Reserve. YouTube. Sorry, it's the most annoying waiting minutes I know. But I'm just asking you guys, can you guys hear the background music here? If you don't, because I got a warning earlier that I don't have any music on you, then we can hear Mr. Powell. So this is radio check 1, 2, 3. Do you hear the background music? It's annoying as crap, I know. Do we hear the background music? When you test it, it's 2 seconds left. Okay, let's go over to Mr. Powell and see if that works out. Oh, I forgot. Powell is not even there yet. So, all right. Okay, cool. And there it is. All right, people. Enjoy.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate, employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point. And we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Nothing new there.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting. And as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina.
Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Inflation progress be enough to hold rates steady from here, or do you need to see below trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything, and we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data, and that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is whenever we get it, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, but what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3%?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But, we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Go to Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is.
Market seems to be reacting to that. He said earlier that we believe the monetary policy is restrictive. I think the market reacted well to that. Euro dollar is currently higher. I've been showing you prices as we go along. Roxana was one of those who bought gold earlier this week, not now, but at a much better price than current price. That is showing some great. So I'm just waiting for euro dollar now to make its high, come up to 11.40, and then come back down, or some sorts. I'm currently just waiting for euro to go higher. I don't know if this is the release we wanted to see. It's kind of like, well, yeah, somewhere in between, but we're almost making a new high here on S&P 500. Nasdaq did come up something, and I saw that on FX Live that Dow Jones had been making new higher highs. So sure, market reacted at least so far in the direction I wanted it to be. So far, so good.
Is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think, today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down, the point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think
as you guys can see here, we have earlier today, we were at 34% here. If you go back in the stream, you will see that. We were 34% earlier now, and now we are back down to 30 of another rate hike in December or by December. So market is now they are now trying to play in one rate hike this year, which is already, or not one rate hike this year, but one rate hike coming forward, which already has happened. This has not been updated forward today. So the market is now more leaning towards there's no more rate hikes this year.
it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy. And there are those who feel, they say it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags plural that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract the mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data. And given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the sluice will come out early next week. And I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source. But I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this sluice will say.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why?
I want to know if he went to the Barbie concert and how was it? Or sorry, the Barbie movie, and how was it? Did he enjoy it? Because if he enjoyed the Barbie and they brought in what 500 million, whatever, over the weekend or whatever they did, is he gonna does he get access to any of that? Did he buy any stocks in that company before it went on air?
Inflation has fallen, and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So interesting question. So let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing. And the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
See, and just to
Oh my God.
follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even
You sound so serious.
split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it's
Hi, Ty. Nice tie. Yeah.
said input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation?
Of course it's Fox News that comes with that comment. Of course it's Fox News. Who else would you expect?
Inflation pressure, and how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so, what was the first part of it?
So wage inflation. Like, how do you target wage inflation without pushing
an economy into a recession.
You don't.
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there, and by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last, in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS.
Strike
and we have the
doesn't matter, you bloody idiot. What did you do? Did you go to finance school, or what did you do? Bloody heck, what have you studied? It's supposed to be finance, not activism.
workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And not,
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people,
do you take the speed into account, how fast something falls? Like, what is this? Is this kindergarten? Is this kindergarten, people? Am I losing my mind as much as you are? Is this kindergarten? Like, can somebody just bring some common sense, or they're just gonna cook up some story? That question actually triggers me. Like, did any one of these do master's degree in economics or anything, or what? Or did they get their license, their job in the post, or what's going on? Do research before you come there.
people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
Steve.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my, that's sort of short, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make. Informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. We've seen so far the beginnings of disinflation without any real costs in the labor market. And that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff.
In the past have 2% that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So. In effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt. But people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Bank of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point? And how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down. And that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. The people in the lower end of the income spectrum have a harder time doing that. So we need to get this done. And the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event, the market had assigned a roughly 99% probability to the rate move that you announced today. The decision was, of course, unanimous. And the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, you could. Was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that there's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed and being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, but we're, of course, very focused on rates and our own policy, working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation looser. We have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing. And ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So to continue it,
You guys got any questions? Yeah, Ian. You guys got any questions? I don't know if I'm gonna bother because he doesn't say anything more now. It's just actually lecturing this guy. Talking the way that I actually talk to you guys. I'm just gonna mention a couple of things that I did buy euro at that pullback over there at 110.80. So I don't know. So I wanted to break. So Elda asked me about should I buy, should I exit? So I said, you can do what you want, but I want to see either break higher or lower of the hourly candle that we made here. And if we don't, then fine. Well, it was fun. It was fun. So I bought, just going to mention that to chat. Where is trades? Because bought euro dollar at 101.85, I think it is. It's 32.83. Stop loss at 110.20. TP 111.38 at this point. Copy image. Just gonna say that. So it's just a little bit of it's a scalp. Scalp. So there we go. I might be wrong, I might be right. I don't really care about it, to be honest. And what is the reasons that they're seeing monetary policy as restrictive? Okay, you said euro, yen. So I want this to make a new high. Okay, so there's a contrary in my mind here. Okay, so one thing is that it's supposed to be seasonality bearish. So any pullback is like woohoo, great, fantastic. Short it. So that's one side of it. Fundamentally, it all depends on Friday on Bank of Japan on Friday. Seems like it's already come very close to target in the week, so there might be a last try, but this might hit target by the end of the week. Did not come up to sell today, but did yesterday. So I would say just want to wait until Friday and see what Bank of Japan says, and probably it's not going to change anything at all. I'm just going to see what's the direction. If they're still going to say, they're not going to tweak, they're still going to do ultra loose monetary policy, blah, 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 I'm still going to wait for the bullishness. There's ECB tomorrow as well, so it is fun. Joshua says USD yen, please, which is bearish. Came down to actually where I wanted it to come down. I feel like this has completed what I wanted it to do. So now it's reset, to be honest. And there's your sell, by the way. So on the week there is a bit more down to 137. So maybe that's the target. Entry has already happened up there, or there for that matter. But if you don't have an entry already on the sell on USDN, then so be it. It is what it is. Basis of Powell said that policy is so yeah. So this is not bullish whatsoever, and I don't find it to be bullish. So maybe if it does that, you can buy it, but at this point, nothing much, to be honest. CAD yen, another bearish one, coming back up to resistance. Still has a long way to fall for the week. So bearish, seasonality bearish, everything's bearish. Any pullback, to be honest. Not any pullback, but if you can get a pullback tomorrow morning before London tomorrow, then that would be great, to be honest. Sorry, there's that one.
Depending on where you are in the cycle. So they're two independent things. And, really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark. Cameron.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance or lack thereof right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed rate mortgage still around industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low rate mortgages, and whereas they might want to sell in a normal situation. They're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it, with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course.
What do you mean by how can it lead to higher food prices? If you take away supply of a certain product, do you think it's going to lower the price of it?
Very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now.
Thank you.
Thanks very much.
Thank you, Mr. Chair. Sorry for being a bit later than everybody else on this YouTube. Summary. Monetary policy is restrictive. Monetary policy is appropriate with another rate hike. They can't say when they're going to cut. They continued to decrease their bond holdings. Labor market is tight. They see that they talked a lot about about mortgage rates and stuff like that. And they are happy that they haven't seen a bloodshed in the labor market, meaning a lot of people hasn't lost jobs, but still inflation has come down. Even though he said that it was positive that that wage rates was high, so people can get back into getting more purchasing power. Even though that's pretty contradictory because he wants it to go lower, because the CPI should go lower. There also the ability to pay should go lower. Other than that, people, any other questions? Thank you guys for being here for 1 hour and 47 minutes. My name is Emilio. I'm going back to making fundamentals on this course. So until you see me then, boom. Happy to be your guide today.